This bank survived the Civil War, 2 world wars, the Great Depression, 158 years, and then, over a single weekend in September 2008, it vanished, the biggest bankruptcy in American history, and dragged the entire global economy down with it. Think about that timeline for a second. A company that watched the United States go from horses to the moon. That outlived empires. Gone in about 72 hours. So here's the question. This whole video answers, how does a 158-year-old giant die in a weekend? Not slowly, not over years. In a weekend. The short version is brutal. Lehman Brothers made one enormous bet, with money it didn't have, on something it was sure couldn't fail. And when that one thing failed, there was nothing underneath to catch it. Hold on to that idea, because everything that follows is just the rise and the fall of that single bet. Let's start with the rise. Lehman didn't begin as a Wall Street titan. It began as a tiny family business, founded by German immigrant brothers in the 1800s. They started by selling goods in the American South, then trading cotton, then slowly moving into the business of money itself. And over the next century and a half, that little firm climbed and climbed. By the 2000s, Lehman Brothers had become the 4th largest investment bank in the United States, with more than 25,000 employees around the world. This was not some fragile startup. This was an institution, the kind of place that felt permanent, the kind of name you assumed would simply always be there. But permanence is a feeling, not a fact. And underneath that proud old name, Lehman was about to make the worst decision in its history. Here's where the fatal bet comes in. In the years leading up to 2008, America was in love with houses. Prices kept rising. Everyone wanted in. So banks handed out mortgages to almost anyone, including people who couldn't really afford them. Those risky loans had a name: subprime. Now, on its own, one risky mortgage isn't a catastrophe. But Wall Street did something clever, and as it turned out, something dangerous. It took thousands of these mortgages, bundled them together, and sold them as shiny financial products. Mortgage-backed securities, CDOs, packages of debt that were supposed to be safe, because surely not everyone stops paying their mortgage at once. Lehman didn't just dabble in this. Lehman went all in. It loaded up on these mortgage products, betting heavily that the housing market would keep climbing forever. And here's the part that turned a bad bet into a death sentence. Leverage. Let me make leverage simple. Imagine you have $1 of your own, but you borrow 30 more, and you bet all 31. If your bet goes up a little, you get rich. But if your bet drops even a few percent, your $1 is gone, and now you owe everyone else. That was Lehman. Its leverage was running above 30 to 1. Which means a drop of just 3 or 4% in the value of its assets could wipe out everything the firm actually owned. There was almost no cushion, no room for error. So picture the trap they'd built. A giant pile of mortgage bets, balanced on a sliver of real money, all resting on one assumption: that house prices would never seriously fall. Therefore, the moment house prices did fall, the whole structure was doomed. And in 2008, they fell. As Americans started defaulting on those subprime loans, the value of all those bundled mortgage products began to collapse. Suddenly, Lehman was holding billions of dollars of assets that nobody wanted to buy. Its thin cushion of real money evaporated. The firm that looked permanent was now quietly insolvent. But here's the thing about a bank. A bank runs on confidence. As long as everyone believes you're fine, you're fine. The second they stop believing, it's over. And by September 2008, the world had stopped believing in Lehman. And it didn't help that Lehman had been quietly hiding just how shaky it was. In the months before the end, the firm used an accounting trick, later nicknamed Repo 105, to temporarily shove tens of billions of dollars of debt off its books right when it had to report its numbers. On paper, Lehman looked healthier than it actually was. So when the truth finally leaked out, the betrayal of trust made the panic even worse. People didn't just think Lehman was weak. They felt lied to. Which brings us to the weekend. the 72 hours that ended a century and a half. That Friday, the U.S. Treasury Secretary, Henry Paulson, called the most powerful people on Wall Street into a room at the Federal Reserve in New York. The message was blunt. Find a way to save Lehman yourselves, because this time, the government is not putting in a single penny. Now that surprised people, because earlier that same year, the government had helped rescue another failing bank, Bear Stearns. And just days earlier, it had taken over the mortgage giants Fannie Mae and Freddie Mac, so Wall Street assumed Washington would ride in again. But Paulson drew a line. He was worried that if the government kept catching every reckless bank, banks would just keep making reckless bets, knowing they'd always be saved. So this time, Lehman would have to be rescued by a buyer, not a bailout. So the race began to find that buyer. And for a moment, it looked possible. The first hope was Bank of America. But Bank of America took one look at Lehman's toxic pile of mortgage assets and walked away. Instead, it bought a different troubled bank, Merrill Lynch, and left Lehman behind. The second hope was bigger. Barclays, a major British bank, actually wanted the deal. Through Saturday and into Sunday, lawyers worked frantically to make it happen. It looked like Lehman might just be saved at the last second. And then it died on a technicality. Under British law, Barclays couldn't guarantee Lehman's debts without first getting approval from its own shareholders. And that vote would take weeks. Lehman didn't have weeks. It had hours. The only way around it was for a government to step in and waive that rule. The British regulators refused. The American government refused to guarantee it either. So the deal collapsed. And just like that, every exit was sealed. In the early hours of Monday, September 15, 2008, Lehman Brothers filed for bankruptcy. On paper, it had around $639 billion in assets. It was, and still is, the largest bankruptcy filing in American history. That day, traders walked out of the building carrying cardboard boxes of their belongings, and that image flashed around the world. The Dow plunged more than 500 points, its worst drop since the attacks of September 11th. But here's the part the title promised you. Lehman's death didn't stay inside Lehman. This is the fallout. And it's where one firm's bad bet became your problem, even if you'd never heard the name Lehman Brothers in your life. See, big banks aren't separate islands. They're all tangled together, lending to each other, insuring each other, betting with each other. Lehman owed money to countless other institutions. So when Lehman died, everyone who was connected to it suddenly panicked. Who else is holding this same toxic stuff? Who's next? The very next day, the giant insurance company AIG, which had promised to cover huge losses on these exact kinds of mortgage bets, nearly collapsed too. The fear spread like a virus. And then lending froze. Banks were so scared of who might fail next that they basically stopped lending money, to each other and to everyone else. And when banks stop lending, the entire economy seizes up. Businesses can't borrow to make payroll. Families can't get loans. The machine grinds to a halt. The result was staggering. Around the world, stock markets cratered, erasing something on the order of $10 trillion in value. Lehman's own stock lost more than 90% of its worth. Millions of people who had never gambled on a single mortgage lost their jobs, their savings, their homes. A bet made in the towers of Wall Street landed on kitchen tables everywhere. And try to actually picture $10 trillion vanishing. If you had spent $1 million every single day since the pyramids were built, you still wouldn't have spent $10 trillion. That's the amount of wealth that evaporated from the world's markets in the chaos. Not because a war broke out, not because a country was destroyed, but because one bank's bet went bad and confidence everywhere snapped. Now, before we land this, one honest note. It's tempting to say Lehman alone caused the whole crisis. The truth is more complicated. The system was already sick. Bad loans, too much leverage, and reckless risk were everywhere, not just at Lehman. Lehman wasn't the disease. Lehman was the moment the disease became impossible to ignore. It was the trigger. not the lone cause. But that almost makes the lesson scarier, not smaller, because here's what really happened. One firm convinced itself that something could only go up. It bet nearly everything on that belief. Then it multiplied that bet with borrowed money until there was no margin for being wrong. And because that firm was wired into everyone else, its private mistake didn't stay private. That's the whole story in one line. One firm's reckless bet, multiplied by leverage, became everyone's catastrophe. A bank that survived the Civil War, 2 World Wars, and the Great Depression couldn't survive its own greed. And neither for a while could the rest of us.